All right, welcome in. Happy Tuesday. This is the Cow Guy Close. And yeah, I'm Scott Shellady, otherwise known as the Cow Guy. Maybe it's the jacket that gives me away. Who knows? But let's get going. We got another great show in store. This is getting good, right? How about this? Yesterday was a big day for the ag market, right? And the nation's producers out there, they saw the WASDE report. That's the World Supply and Demand Report. Well, that's now past us. And today we shift gears to inflation. All eyes were on today's release of the CPI. That's the Consumer Price Index. Now, it came in a little softer than expected. Month-over-month reading was 0.2% when we were expecting a 0.3% reading. And year-over-year was just a shade lighter to it, 2.3 versus 2.4. So I can hear it now, right? Inflation is easing, so the calls for rate cuts are going to begin to grow. But I feel as though the economy is strong enough to really stand on its own. And at this point in time, rate cuts should be saved for bigger instances. I don't want to use the word emergencies, but I would keep them in my pocket. I'd keep some powder dry there. The Fed funds rate at 4.25 to 4.5. I don't really think is that restrictive, and I think the economy is telling us that, but that's for a whole nother show. But the inflation doves and long equity players, they're going to be beating the rate cut drum until they get what they want. I think they actually might get it. So we wanted to get someone on that could cut through all that noise and tell it to us straight. Let's bring him on and see what he's got to say. Mr. Eddie Ghabour, with the Key Advisors Wealth Management in Delaware. Thank you very much, Eddie. All right. I don't know if you disagree or agree with anything I had to say there, but we're going to hear that steady drumbeat of we want rate cuts, right?
We are going to hear that, and I'm on your camp. I don't think they need to cut rates. As a matter of fact, I think cutting rates will be problematic for the market because if they cut rates right now, I think there's a potential for the 10-year Treasury to go higher. And to me, the 10-year Treasury is a lot more important than the federal funds rate. And there's no reason to cut rates right now. They used that ammunition last year when they should have saved it. And the only thing in cutting rates would do right now is actually increase the probability of inflation reaccelerating going into the next 2 quarters. And here, the bottom line is this. We're celebrating a softer number. The core is still nowhere near 2%, and that's what the Fed continues to beat the drum to, is they're not going to cut till they get to 2%. I think they'll be forced to pivot from that, but I wouldn't expect any more than one rate cut, and we may even not even get any. But I think the soonest we would see one will be sometime in September, and that's what the bond market's pricing in right now.
So I'll be a little controversial here, and I don't know if you'll agree with me on this one or not, but, let's just take a look back to last September, 2024, 6 weeks out from an election. Stocks at all-time record highs, and he decides to cut rates. Powell decides to cut rates. Fast forward to April of 2025. We have a 14% sell-off. Everybody's throwing out the baby with the bathwater. It looks like the world is going to end, and he stands pat. I don't know about you, but that doesn't pass the smell test with me.
It really doesn't. To me, that was a major head scratcher for us when they were that aggressive in rate cuts at a time that we didn't need it. I am all about saving the ammunition for when you need it. And we did need a little bit of that earlier this year, but they forced themselves into an impossible position where growth is going to have to slow tremendously, and there's going to have to be major headwinds for them to move the needle on rates because of them cutting by 75 basis points last year. And so they're put themselves in an impossible predicament where you could get a scenario, what I hope doesn't happen, where they're forced to raise rates if inflation gets too hot in a time period when the market probably needs them to cut. That's not our base case. But I wouldn't take that off the table right now when you look at the next 12 to 24 months and what that potential setup could look like.
I mean, it's just they put themselves in a difficult spot where they have to choose between inflation and the economy and jobs. I mean, it's a no-win situation for them. So here we sit, and you and I talked about this off air, and we both, I think, kind of agreed that, the road going forward looks pretty good. I mean, we're going to probably get something out of that big, beautiful bill. I mean, they're going to wrangle about it because they want the headlines. And whether I think we're going to get a rate cut or not doesn't matter what I think. It's just what happens, and I think they're going to get one at least. So that doesn't bode well for somebody that's short the market and needs to buy at lower levels, does it?
No, it doesn't. Look, this bull market is back right now, and you have to I can't find a bearish case right now. Doesn't mean you're not going to have corrections, but the bottom line is I think there's a lot of people that are underinvested. They weren't buying the dip that happened last month. And I think any red on the screen they're going to be forced to buy because of their performance being so lackluster. So as they say, don't fight the trend. The trend right now is bullish. You need to be buying dips if you got the right risk tolerance. And I think it's a really good thing. There's some people upset about this. I don't know what you could be upset about with positive news coming from the China talks. Thank goodness for Scott Bessent. I think he's an amazing asset to this country. And look, it's going to be off to the races. The pain trade is higher right now, and don't fight the trend because it's your friend.
And exactly right. And so you had awesome opportunity to pick up some of these stocks at great valuations. I mean, there was some stuff that was just ridiculously priced. I was able to pick up a little bit, but now that I've got hindsight, I should have been picking up a lot more. But I'll take it. And I think the rest of the market's probably in that situation as well. So going forward, I mean, do you feel as though there are still opportunities out there? What do you have your eye on in case we do get a little bit of a pullback?
Absolutely. I mean, most stocks aren't even back to their highs yet, okay? And if we continue to make lower highs and higher highs in the market, you should expect the market over the next 6 to 12 months to break through all-time highs. And that means the areas like software, like your semi-conductors, like your consumer discretionary names, those places have been really beat up, and they have a lot of catching up to do. And so you can dollar cost average into those areas, and if we make new highs, you should expect those to have a catch-up trade. You've seen it already since Monday. I think the trend that you're seeing, the names that are doing the best this week are going to be the ones that continue to trend higher, because those were the areas that were beat up so well and did not have good relative strength during the sell-off. So I still think there's plenty of opportunity in this market. You just have to pick your spots and be patient.
Otherwise known as being efficient. And, there's a few names out there. I mean, one of them I was watching. You can take a look at, say, Tesla. I mean, that got down around 220-ish, 215-ish. I can't remember what the low was, but it's over 300 now today. You've got ample opportunities there to still maybe capital. And by the way, what's the all-time high in that? Over 400 something, right? So there are some things out there that still can look attractive. I'm not saying buy that stock, but I'm saying that there still are opportunities, just like what Eddie had to say there. So did want to get that out there, right? So I do own a little bit of it, very small amount, but I'm not saying you should buy it. Thanks for being on, Ed. Eddie Ghabour, coming to us from Key Management Advisors in Delaware. Thanks for being on.